Your credit score isn't just a number, it's your financial fingerprint. It dictates the loans you can get, the interest rates you pay, and can even influence job offers you receive. Yet, despite its power, most people are operating under a cloud of myths and misinformation. This is the truth, and it's time you knew it. What is a credit score really? At its core, it's a 3-digit number, typically ranging from 300 to 850, that serves as a statistical summary of your creditworthiness. Think of it as a snapshot of your financial reliability. According to the Consumer Financial Protection Bureau, this single number is used by a surprisingly wide array of institutions. Lenders use it to decide whether to approve you for a mortgage, an auto loan, or a credit card, and at what interest rate. Landlords consult it to gauge your reliability as a tenant. Insurance companies may use it to set your premiums, and in some regions and industries, even potential employers will look at your credit report as part of their background check. It's a silent gatekeeper to many of life's biggest milestones, the 5 factors that actually matter. So, what actually goes into calculating this critical number? While the exact formulas used by scoring models like FICO and VantageScore are proprietary secrets, they are built upon 5 key factors. According to industry leaders like Experian and analyses from sources like Business Insider, the breakdown is surprisingly straightforward. The single most important factor, accounting for a massive 35% of your score, is your payment history. This is simple. Do you pay your bills on time? Every late payment, collection, or bankruptcy filing can leave a significant and lasting negative mark. Being just 30 days late on a single payment can cause a substantial drop in your score. Almost as important, at 30%, is your credit utilization ratio. This measures how much of your available revolving credit you are currently using. It's calculated by dividing your total credit card balances by your total credit limits. For example, if you have a combined credit limit of $10,000 across all your cards and your balances total $5,000, your utilization is 50%. Lenders see high utilization as a sign of financial stress, indicating you might be overextended and at higher risk of default. The general rule of thumb is to keep this ratio below 30%, but the lower, the better. Next, contributing about 15% to your score, the length of your credit history. This factor considers the age of your oldest account, your newest account, and the average age of all your accounts. A longer history provides lenders with a more extensive track record to evaluate your financial behavior. This is why financial advisors often caution against closing your oldest credit card, even if you no longer use it frequently. That account serves as an anchor, demonstrating a long-standing relationship with credit. The final 20% is split evenly between 2 factors. New credit inquiries, which make up 10%, refer to the number of times you've recently applied for new credit. Each time you apply for a loan or credit card, it typically results in a hard inquiry on your report, which can slightly lower your score for a short period. Applying for multiple lines of credit in a short span can be a red flag for lenders, suggesting you may be in financial trouble. The last 10% is your credit mix. Lenders like to see that you can responsibly manage different types of credit, such as a mix of revolving credit like credit cards and installment loans like mortgages, auto loans, or student loans. A diverse portfolio demonstrates your financial versatility and experience. Myths that cost you money. Understanding these 5 pillars is the first step, but just as crucial is debunking the persistent myths that can cost you real money. A pervasive myth, as noted by financial resources like InCharge and The Motley Fool, is that checking your own credit score will hurt it. This is unequivocally false. When you check your own score through a credit monitoring service or directly from a bureau, it's considered a soft inquiry and has zero impact on your score. It's only when a lender pulls your report for a credit application, a hard inquiry, that your score may dip slightly. Regularly monitoring your score is not just safe. It's a fundamental part of responsible financial management. Another damaging myth is that closing old, unused credit accounts will improve your score. In reality, the opposite is often true. Closing an old account can hurt your score in 2 ways. First, it can shorten the average length of your credit history, which, as we know, accounts for 15% of your score. Second, and more immediately, it reduces your total available credit, which can instantly increase your credit utilization ratio. If you have existing balances, your utilization can spike, sending a negative signal to scoring models. Unless an old card has a prohibitive annual fee, it's usually better to keep it open, perhaps using it for a small, recurring purchase that you pay off each month to ensure it remains active. A final, common misconception revolves around marriage. Many people believe that when you get married, your credit score automatically merges with your spouse's. This is simply not true. Your credit history and score remain entirely separate and individual. Your spouse's per credit cannot directly lower your personal score, nor can their excellent credit directly boost yours. However, your spouse's credit can affect you indirectly. When you apply for joint credit, such as a mortgage or a car loan, lenders will pull both of your credit reports. In that scenario, a low score from one partner could lead to a loan denial or a higher interest rate for both of you. Global credit realities. The concept of credit scoring is not universal. It's a global tapestry with distinct local patterns. In the United States, the market is dominated by the FICO score and its competitor, VantageScore, which are used by the vast majority of lenders. Travel across the world, and the landscape changes dramatically. In China, the financial system is evolving with both a state-run social credit system and commercial credit scoring platforms like Sesame Credit from Ant Group, which incorporates data far beyond traditional financial transactions, including online shopping habits and social connections. In Europe, the system is more fragmented. Each country often has its own set of credit bureaus and scoring methodologies. For example, Germany has Schufa, and the UK relies on Experian, Equifax, and TransUnion, each providing a different score. The introduction of GDPR has also placed strict regulations on how personal data can be collected and used for scoring purposes. In a developing economy like Nigeria, formal credit scoring is still in its infancy for a large portion of the population. Many people lack a formal credit history, leading to the rise of mobile lending apps that use alternative data from smartphones like mobile money transactions and call logs to assess creditworthiness. In India, the CIBIL score, generated by TransUnion CIBIL, is the predominant measure of credit health, playing a crucial role in securing everything from personal loans to housing. Meanwhile, in the United Arab Emirates, the Al Ittihad Credit Bureau (ECB) was established to create a national credit reporting system, providing scores and reports for all residents, fundamentally changing the lending landscape in the country. The core insight here is that credit systems are culturally and economically specific. Your strategy for building and maintaining a good score must adapt to the rules of the system you are in. How to improve your score? So, how can you take control and actively improve your score? No matter where you are, the strategy is rooted in consistent, positive habits. First and foremost, pay every single bill on time, every time. Set up automatic payments for at least the minimum amount, due to ensure you are never late. This addresses the single largest component of your score. Second, diligently manage your credit utilization. Actively work to keep your total balances below 30% of your total credit limits. If your utilization is high, focus on paying down your debts. You can also consider asking for a credit limit increase on an existing card, which can instantly lower your utilization ratio, provided you don't increase your spending. Third, be strategic about new credit. Avoid applying for unnecessary loans or credit cards. When you do need to shop for a loan, like a mortgage or auto loan, try to do all of your applications within a short window, typically 14 to 45 days. Scoring models often recognize this as rate shopping for a single loan and will bundle the inquiries, treating them as one, minimizing the impact on your score. Fourth, intentionally build a healthy mix of credit over time. Successfully managing both an installment loan and revolving credit demonstrates your financial maturity and capability to lenders. Finally, leverage technology. Use free credit monitoring tools like Credit Karma in the US and Canada, ClearScore in the UK and South Africa, or Microdebtinfo in Nigeria. These services allow you to track your score, understand the factors affecting it, and spot any potential errors or fraudulent activity on your report. Summary: your credit score isn't fixed. It's not a permanent label etched in stone. It is a dynamic, living number, a reflection of your habits, your discipline, and your financial decisions. And every decision you make, every payment you submit, every balance you carry moves it. So move wisely, take control, grow relentlessly.